you own a holiday home that you rent out part of the year, and then quietly block it out for your own family every Christmas, this one's for you. Because from the 1st of July 2026, the ATO can look at exactly that pattern and decide your investment property isn't really an investment at all. It can label it a leisure facility. And once it does, almost every deduction you've been claiming, gone. Here's the scope. About 2.24 million Australians lodged rental schedules in 2021 to 22, ATO 2021 to 22, and the ATO has named holiday homes as a key focus area in its rental deduction crackdown. The fix comes down to 3 moves: audit your usage, fix your pricing and access, and document your private use. Do them and you stay deductible. Ignore them and you're exposed. Let's land the number. 2.24 million landlords ATO 21 to 22 are now in scope, and the ATO says it's seeing extensive incorrect claims, with disallowed deductions often running into the tens of thousands of dollars per property. But here's the part nobody tells you. When the ATO reclassifies a property, there's no apportionment. It doesn't trim your deductions. It denies them in full, even for the weeks the place was genuinely rented. 3 moves. Audit your usage against the ATO's rules. Fix your pricing and open up peak season, and document your private use so you apportion. Each takes under 30 minutes, and they're all free. So how does the trap work? Under Draft Ruling TR 2025-D1, the ATO asks one question: is the property used or held mainly to produce assessable income? If the answer is no, if it's really there for your family's holidays, it can apply Section 26 Side 50 of the Income Tax Assessment Act and treat it as a leisure facility, ATO TR 2125-D1. The red flags? Not making it available in peak seasons. Setting rents so high nobody books. Renting to friends at mates rates. Blocking popular dates for yourself while claiming it's available. And the impact in dollars is brutal. Take a typical $900,000 coastal home with about $60,800 a year in holding costs. Authors estimate. Treat it as a genuine investment. An owner on a 39% marginal rate saves roughly $2,400 in tax every year. Modeled ATO 2026. Reclassified as a leisure facility, that saving collapses to just $2,000 or $3,000. CPA Australia 2025. Interest, council rates, land tax, insurance, repairs and depreciation, all denied. Only the direct costs like cleaning, advertising and platform fees survive. Now the second layer. While the Commonwealth turns off your deductions, the states pile on. Victoria is the clearest example. From the 1st of January 2026, the vacant residential land tax extends to undeveloped residential land in parts of metropolitan Melbourne, charging 1% of the capital improved value, and that rate rises 1 point each year it applies, up to 3% cap, William Buck 2025, and it's on top of your normal land tax. So picture an $800,000 block. In year 1, VRLT costs $8,000, year 2, $16,000, and at the cap, $24,000 a year, William Buck 2025. Over 5 years at the cap, that's roughly $120,000, just in the state surcharge. The old habit, block the holidays, inflate the rates, claim everything, is now the high-risk pattern that gets you denied. The compliant habit, genuine peak availability, market rate pricing, documented private use, is what keeps your deductions alive. Here's the myth that catches people. They think, my listing is live all year, so it's available for rent, so I can claim everything. Wrong. The ATO looks at real availability, real pricing, and your actual private use, not whether a listing technically exists. ATO 2026. Block every peak date and it's not mainly for income. Open those weeks and price at market rate instead. Put the two costs side by side. On the federal side, around $23,000 a year in lost tax benefit when deductions are denied, modeled ATO 2026. On the state side, up to $24,000 a year at Victoria's 3% VRLT cap, William Buck 2025. Together, over a decade, that's easily 6 figures, money that could have gone to your super instead. Meet Lisa. She's 48, a senior nurse in a public hospital earning $135,000. In 2022, she bought a coastal holiday house in New South Wales, now worth about $1 million, with an interest-only loan of $800,000. She rents it on Airbnb for around 90 nights a year, blocks it out for her family over Christmas, Easter, and school holidays, and lets friends stay at half the advertised rate. She's always claimed it as a rental investment. Discovery 1. Under the ATO's high-risk indicators, significant personal use in peak periods, limited renting, restrictions on guests, Lisa's pattern lights up like a Christmas tree. Picture Partners 2025. She was planning to claim the full $59,000 a year in ownership costs, saving about $23,000 in tax at her 39% rate modeled. If it's a leisure facility, that $23,000 vanishes and she can only claim a few thousand in direct rental costs. CPA Australia 2025. Discovery 2. Lisa assumed her live listing meant the place was available for rent and fully deductible, but she blocks out about 120 peak season days a year for herself and friends. ATO 2026. On a proper apportionment, she could only claim for roughly a quarter to a third of the year, the 90 rented nights. That alone slices $40,000 to $45,000 off the deduction she expected. Modeled. ATO 2026. Discovery 3 is the one that stings. If Lisa changes nothing, and the rules apply from the 2026-27 year, she loses around $21,000 in tax benefit every year. Modeled. CPA Australia 2025. Over her 17 years to retirement, that's about $357,000 in extra tax, before you add a cent of state surcharges or the compounding she'd have earned investing those savings. Stack it all up and Lisa's lifetime hit lands near $400,000, $357,000 in denied federal deductions, plus around $51,000 in extra state land type charges over 17 years. Modeled. ATO and VRLT settings 2025. One quiet habit, blocking the school holidays, turns into a $400,000 mistake. So could this be you? 3 signs. 1. You block out Christmas, Easter, or school holidays for your own family. 2. You let friends or family stay at below market or mates rates. 3. You've set the rate so high it barely books, yet you still claim full deductions. If any of those ring true from 2026, the ATO can call your place a leisure facility. So where does all of this leave you? You don't need to overhaul your whole financial life. You just need a few specific practical steps you can start today. 3 moves. Let's do them. Move 1. Audit your usage against the ATO's criteria. Head to the ATO's Holiday Homes page under Property and Land. It walks through exactly when you can claim, when you must apportion, and the high-risk indicators that trigger a leisure facility classification. Pull up your own calendar and compare honestly. How many nights were genuinely rented and how many did you block for yourself? This is general information, not personal advice. Here's how. Pull your booking calendar and total your rented nights against your private nights. Mark every peak period date you blocked for personal use. Then check it against the ATO's high-risk list. What good looks like? The property is genuinely available for the majority of peak weeks. Move 2. Fix your pricing and open up peak season. The ATO treats mates rates and inflated rates as evidence you're not really trying to earn income, so set your nightly rate within about 10% of comparable local listings. Drop the discounts to friends and make Christmas, Easter, and school holidays genuinely bookable for paying guests. Here's how. Compare your rate to 3 to 5 similar local listings on Airbnb or stays. Remove unreasonable restrictions like no kids or pets that deter bookings, and unblock those peak dates. What good looks like. Occupancy climbing toward 200 paid nights at market rate. Move 3. Document your private use so you can apportion instead of losing everything. Keep dated records of every personal stay. That way, expenses for the rented portion of the year stay deductible and aren't denied wholesale. Then have a registered tax agent confirm your position before you lodge. Here's how. Log every private night with the dates and who stayed. Apportion your ownership costs to the income-producing days, and have a registered tax agent review it before you lodge for 2026-27. What good looks like. Clean records that prove income purpose for the rented share. Why now? Because the deadlines are already locked in. In 2025, the ATO issued draft ruling TR 2025-D1, setting out the leisure facility approach under Section 26-50. From the 1st of January 2026, Victoria's vacant residential land tax extends, charging 1% rising to a 3% cap William Buck 2025. And from the 1st of July 2026, full compliance is expected from the 2026 to 27 income year. The ATO says it won't review expenses before that date, but after it, your usage pattern is the evidence. Once you've acted, verify it worked. You should see paid bookings spanning the peak periods, not just the quiet months. Confirm your nightly rate sits within about 10% of comparable listings. And if your private use is properly logged, then you can apportion your costs rather than lose the lot. Everything here comes from the ATO's own guidance, CPA Australia, Pitcher Partners, and William Buck. Links are in the description below so you can read TR 2020-55D1 yourself. Today you learned how the ATO's leisure facility rule can wipe out your holiday home deductions from 2026 and the 3 moves that protect them. Next week, the Airbnb income the ATO already knows about. If this saved you from a $400,000 mistake, subscribe. We read the fine print so you don't have to.